Welcome to this lecture on the historical analysis of real estate cycles. We're going to be looking at past data and comparing our observations with the conclusions we've drawn from our real estate cycle model. Real estate market fundamentals tend to behave similarly over time, so what we learn here should be applicable to future cycles. Let's start with GDP, the most important indicator of the performance of the economy. I have extracted this chart from the National Association of Real Estate Investment Trusts. As you may already know, GDP, or Gross Domestic Product, is a metric economists use to measure total expenditure by businesses, consumers, and the government. The blue line measures the amount of business expenditure relative to total GDP. Out of the three components of GDP, business expenditure is the most volatile and has proven to be the main cause of the volatility of the economy. On average, business investment comprises about a quarter of total GDP, as shown by the black horizontal line on the chart. The shaded gray vertical lines show periods of recessions. Notice that when business investment falls, as indicated by the blue line, it tends to do so drastically. Notice how this is normally followed by a recession. The message is that recessions tend to follow periods where GDP has exceeded the average by a significant amount, and that the economy moves in cycles, in alternating bursts of expansion and contraction. In this chart, we show how commercial real estate property prices have evolved since 1998. The index is set in 2007 at 100, after which the market dropped almost 37% from peak to trough. Subsequently, the market grew constantly for 10 years, through 2019. Note the shape of the curve and the drop in property prices starting in 2007, and how it dropped drastically starting in 2008. Over this period, we went from expansion to deceleration to contraction in a matter of 2 years, with a recovery and expansion phase lasting a whole decade. This chart shows the investment volume in the US in billions of dollars from 2007 through 2020. As we saw in the previous slide, 2007 represents the peak of the market during that cycle. 2008 marks the deceleration, and 2009 the contraction. With $70 billion in transacted volume during that period, that represents an 82% decline in the market. As you can gather from the chart, it wasn't until 2014 that the market recovered the previous transacted volume. This chart shows acquisitions and dispositions per quarter by real estate investment trusts from 2004 through 2019. The black line are the net acquisitions, or acquisitions minus disposition. Following what we saw in the previous slide, we observe how an institutional investor such as a REIT follows the trend in the market, buying aggressively during market expansions, such as the 3-year period leading to 2008, and pulling back almost absolutely during market contractions, as they did during the period between 2009 and 2011. As discussed during the previous lecture on the real estate cycle model, the occupier market trails the investment market somewhat, which has the interesting effect of widening yields when the market is in a downturn. That we will see in the next slide. This chart shows net absorption less completions for different market segments, including apartment, office, retail, and industrial. When the data points are below the zero line, completions exceed net absorption, increasing inventory. This should cause vacancy rates to rise. This phenomenon is particular to the real estate market. Real estate development is a slow process and trails the economy by a year or two. Long after investment volumes and prices have peaked, as projects in development are completed, they come onto and flood the market with empty space, contributing to a market that was already weakened by the sluggish economy. Here we look at how cap rates have behaved since 2002. The blue line is the US apartment cap rate. Note how cap rates have plateaued starting in 2006, starting with the end of the expansion phase and rising with a contraction until they peak in 2010, only to come back down again, coinciding with the recovery and expansion phases that took place in the decade after 2009. The orange line is the yield spread between bonds and commercial real estate cap rates. In a widely traded and liquid market, such as those as commercial real estate and bonds, the higher the return of an investment, the greater the perception of risk that investors have of such an investment. When the yield spread is high, investors perceive real estate as risky in comparison to bonds. When spreads are low, investors perceive real estate to be less risky in comparison to bonds. Periods of low yields are associated with higher pricing because investors are willing to accept less compensation or return in exchange for undertaking an investment. Notice how low yields were in 2006 and 2007, coinciding with the expansion phase of the market. We mentioned in the lecture of the market cycle that investors are aggressively pursuing deals in this moment, outbidding one another. The low spread of commercial real estate relative to bonds is an example of this. This chart shows cap rate behavior in the office market since 2002. Notice how office parallels apartments, but the turns are more dramatic, with a cap rate rising sharply between 2008 and 2010, to come back again during the recovery after that. I hope you found this discussion on the historical behavior of the real estate market cycle interesting. If you have any questions, feel free to email or contact me via Instagram.